You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where we continue our journey into the world of rules-based investing and share our experiences with you each week, hoping that you can find a few golden nuggets to implement in your own investment journey. As usual, let me start by saying good morning to you, Jerry. Good afternoon to you, Moritz.
Well, good morning to both of you.
Yes, good morning.
Yeah, I was going to do my usual wrap of the markets this week, but frankly, I didn't find much to talk about. I'll be interested to hear what you saw, Moritz. But I've been on the road most of the week, and so of course we know that kind of the risk-on environment has continued this week, with safe havens being dumped in exchange of the ever-rising appetite for equities at new all-time highs. I guess the dollar had a little bit of a comeback this week, which is interesting. But I guess the most interesting thing I found from the world of finance this week was, just this glimmer of insight that we are now getting into the secret world, I should say, of Jim Simons, Renaissance Technologies, and Medallion Fund. I thought that was a fascinating book that came out this week. I know you guys haven't necessarily read all of it, even though there were some great tweets from Jerry. I'm sure we're going to get into that later on. And we can talk about this later. We can stay on our normal topic. But I thought it was very, very interesting to see some of the things that the author had been able to find out about how it all works and how the people behind Renaissance Technologies, their story and how in many ways, maybe with the exception of their incredible performance, have very similar traits to the rest of us. But let's see how we go and how much time we have to talk about these things. Why don't we just do as we normally do, Moritz, hear a little bit about how your week in the trend space went?
Yeah. So how did it go? I remember a relatively volatile week for me in terms of daily returns. Ended the week roughly flat, maybe slightly down. But like you said, Niels, it's been a risk-on environment through and through. I mean, the move up in the equities is kind of like relentless since at least this past week, maybe even the week before. And so I'm long the equities, which was good, but I'm also still long the bonds, not as much as I used to be. I think I've mentioned that last week. But here, the move down in bonds and, yields moving higher is as relentless as equities moves higher. So it's kind of like the double whammy for my portfolio. I'm long gold. That didn't work. So I was just lucky that, I had a couple of positions on in the currency space and in the energies, which, counterbalance the losses from those two asset classes. So I think I'm slightly down. But what I do remember, I had, every once in a while I looked at the portfolio during the week and I had relatively large percentage moves, which, when I look at things such as like crude oil, the thing just, goes down $2 and then, all of a sudden it pops back up $2 and it's like yo-yoing around. And I've seen the same in some other markets as well. So, that's that. We're sitting here following our systems. This is what we do. And then this devil in my head, which is the discretionary trader who I'm trying to mute and shut down all the time, always tells me, well, those equities are too high. They need to drop at some point, but no, it doesn't seem to be the case. There's things like Tesla moving higher and higher. A stock which many of us probably would have said is going to go out of business at some point, but no, not so fast. So try to not think about it too much. Look at the price only. Mute my brain on all those fundamental noises about the stocks and just follow on.
Yeah, it's funny you mentioned the thing about the discretionary trader inside you're trying to mute. That's actually one thing that is a little bit of a surprise to me when I went through the Jim Simons book. That there is uh, certainly in their early days, I would say a lot of their gains were actually from discretionary trading. They couldn't quite get the rules to do what they wanted, and so on and so forth. And I think still, even to this day, there are elements of that discretionary trader showing up, not necessarily, I think, in their actual trading, but just how they react to certain things, like Q4 last year. There's a bit of a story on that, and how Simons, was tempted to make some calls on that for his, at least for his own portfolio. So interesting. I think that trader will always be lurking somewhere in the background. But like as you said, I mean, a lot of these markets looks like they're in some kind of transition, and a lot of them are just stuck in ranges. You mentioned the oil going up and down. I just saw the news this morning that now I think Iran has found a massive oil reserve, 55 billion barrels, as far as I could tell from the news headline. So we'll see. Probably will continue for a while longer, going into next week as well. And so, like you, I mean, we probably had, we did have a down week. And nothing dramatic, but it was a bit of a down week. So gains in equities certainly offset by losses still in fixed income, even though that exposure has been reduced quite dramatically by now. And what else? The dollar was okay for us. That was actually fine. Gold, silver, yeah, we lost a bit of money on that, just like you mentioned. But we also had losses in coffee and nat gas. So all in all, a bit of a down week. But it's interesting now going over to you, Jerry, and obviously with the single stocks that you trade. So in the book, again, it mentions, and this number might even be bigger by now. I can't remember exactly the timeline of this, but where they talk about trading, several thousand stocks, in their portfolio at Rentec, and also what really surprised me, which we can talk about a little bit later, was just the activity of which they were active in the markets. And there was a great tweet from Wayne actually yesterday where he said something about 5% of the time we should be active, but 95% of the time we just shouldn't do anything. And of course, in our world, that's pretty much how it works. But when you then see in the book about Rentec, how I think it was back in 2001, even at that time, they were trading 150 to 300,000 trades per day. I mean, that is not being sitting on the couch, that's for sure. So, I mean, different ways of doing things. But it was interesting to see how active and how much cracking the individual stock market, the importance of that for Renaissance Technologies, which of course, Jerry, you've already cracked the individual stock market or stock trading trend following. So over to you.
Yeah, I haven't cracked that quite yet, but I do think it's an easy call to diversify and trade some single names. But I think it's we're at a critical place in the metals and the bonds, the precious metals and the bonds. Are these trends going to continue? So that's kind of a bummer that didn't work out, or doesn't look like it's working out. I got a message from someone this week on Twitter about commenting about still being short cattle, which I think I still am short. The cattle was quieter this week maybe, but he's like, how can you still be short? It's been up 8 weeks in a row. And I'm like, oh yeah, I guess I am kind of long term, 8 weeks in a row. It sounds like a trend reversal, I guess. But I guess my systems can do that. But my comment, I wanted to comment on the discretionary piece, and I think it's kind of like in our world, what happens is we fight off our mentality of thinking about how much we'd like to do something discretionary, but we still have this unfortunate outlet where we can go and tinker and change the rules, which I think is about the same thing. So we'll maintain our claim that we're not being discretionary, but we can get sucked into this idea of let's change the unit size a little bit. Maybe I'm trading the bonds too heavy. I can get out of a few, or we'll change our exits a little bit, and maybe that'll reduce my exposure to a painful trade that I'm in. So I think that's something to still guard against, even though we're not actually doing something discretionary. It's sort of the same type of discretion to be emotionally influenced and change the rule a tad. So I've done that, and it's not. It's basically the same thing.
Yeah, no, absolutely. But anyways, I know it's been maybe not so exciting in the markets this week, but it's been very exciting in the Twitter space. But before we jump to that, we actually do have a voicemail this week. Jim, who were at our live event in New York a couple of weeks ago, left us a voicemail. So let me just play that right now.
Hey guys, Jim from Fort Myers, Florida. Just a couple comments about the live event last week. I really can't put into words how much I took away from there. To be able to sit with the three of you in a small group setting and have our questions answered, straightforward, honest, forthright, with a positive slant to everything is just really awe-inspiring. You know, a lot of us are still developing our systems, and the fact that you guys put it in a positive framework, and we know from the successes that the three of you have had that we know it's possible, and that opens up a whole world of possibilities for us. We had such a great group of guys, the three of you, so much information, so nice talking and getting to know the three of you, and the lunches and the dinner. I mean, we just had such a great time. I came back really fired up, almost couldn't sleep for a couple of days because I just want to look over charts and data. And I really, really had a great time. I can't put it into words. I don't think the three of you realize the impact that you have had on us, not only in the live event, but also in the podcast. And a testament to that is having somebody from all over the world. We had somebody from Australia, somebody from the UK, a bunch of us from the US. So keep up the good work with the podcasts. And I really can't wait for another live event. Just such a great time. It's really hard to express it, but from the bottom of my heart, I'd just like to say thank you very much. It was so nice to get to know you guys personally, and plus the information you provided, and I really, really thank you. Thanks, guys.
Jim, thanks so much for your kind words and feedback from our live event. Jerry, Moritz, and I very much enjoyed spending 2 days with all of you, and so I'm glad to hear that it had a big impact on your trend following journey. Keep it up. And we'll, of course, keep in touch with all of you from the live event in our little secret online group that we set up to do just that. And, of course, if you're listening to this and you want to leave us a voicemail in general, a comment, then feel free to do that. You can go to toptradersunplugged.com/voicemail. Now back to social media land. I know this week has been interesting to say the least when it comes to your tweets, Jerry. So do tell.
Yeah, it's been a good week. It's been a fun week. Pretty much dominated by the Renaissance Simon's book. A lot of good quotes. I haven't finished or started the book really, but I feel like I've read a lot of the book because there's been so many articles and some interesting podcast interviews of the author. So it's, for me, it was a record-setting week. My most popular tweet ever by a factor of, probably 4 times as many people liked this tweet than any tweet ever. And it's pretty funny. And so it goes like this. When it notched up its first $1 million one-day profit in 1990, Simons handed out champagne. But 1 million one-day gains quickly became so frequent that the drinking got a bit out of hand. So there you have it. Be embarrassed, all 907 people who like that tweet, because I guess maybe drinking can get out of hand, and that's kind of funny.
Yeah. Well, it's pretty impressive when you go through the book, and certainly in the appendices at the end of it, you see some of not only the annual returns that they ended up producing in the Medallion Fund. And I should say that, Renaissance Medallion Fund is only for themselves nowadays, has been for probably the last 20 years or so. So it's not where investors can invest. But when you look at the gains, the net gains that this fund has taken out of the markets in the last many years, I think it's more than $100 billion that they quote now as the amount of net profits they've taken out, or gross profits, I should say, before fees. Someone has been on the other side of that, so they are a formidable force in the market without a doubt, and it's an impressive track record.
Yes, very impressive.
What else? Yeah. What else did people like in Twitterland?
Larry Height, he pops up every now and then, and his book is out there, and he's tweeting a lot about the book, and I haven't read that book either. I have both on my Kindle, but people really love Larry, and this one got a lot of notice. You can be right most of the time, but still lose everything if you put too much on one wrong bet. Most importantly, the market will never say it's sorry. Larry always has some wisdom and something kind of funny as well. So I thought that was pretty interesting. Just something, we've all been talking about for many years, to be diversified. And certainly it's very appropriate and just fine to call it a bet and bet conservatively and diversify. And so that's one of his rules and one of his advice for people that people found interesting and probably agree with.
Yeah, I mean, I like those Larry Height quotes really a lot. They have like a genuine simplicity and truth to them, which only he can get across in that way, I have the feeling. And I remember another one that he said, I don't have it in front of me right now, but let me try. Maybe I remember it correctly. It was about taking small losses all the time. And he was saying like, well, it feels like it's the wrong thing to do because you're actually taking a loss, right? And that's bad. So he says like, sometimes you have to do the wrong thing because it's the right thing to do. And obviously this is super correct because we know this is how the game is played. This is how we need to play each and every single bet. I actually like the thinking in bets as well here. We bet on the rocket ship. Let's get on the rocket ship. It fails. Feels like the wrong thing to do because we're taking a loss, but you have to do the wrong thing because it's the right thing to do. This is by Larry Height. Something like that. I think probably 90% of that quote is correct, I hope.
Yeah, no, it's so interesting to hear these people. I mean, Larry Height compared to Jim Simons, I think they're quite opposite in many ways, yet both obviously have been very successful. Not to the same degree in terms of net wealth today, but it doesn't really matter. I mean, they have both been incredibly successful in their field, but they kind of come at it slightly differently. And Larry has this amazing way of putting things in a very straightforward, easy to understand way, without a doubt.
And it would be nice if we could hear more of Jim Simons. There's a couple of things on YouTube, which I guess we've all seen. Maybe there's 2 or 3. And he's like this larger-than-life superstar in terms of trading. It's quantitative trading, systematic, I hope, or I think it is, at least to the largest extent now. So you kind of like to learn more, read more, see more about that firm, but it's so closely kept to themselves that it's difficult really to find anything. So I'm really looking forward to reading that book. I've mentioned I've pre-ordered it on Amazon, but it hasn't arrived yet. So, but the day the mailman rings the bell, I'll pick it up and open it up and start reading.
There are a lot of references in the book, I think, at the end of it, where you can see, articles that the author used and so on and so forth, which is great. But I also think from listening to an interview, I think the same one that maybe both of you, or at least Jerry, listened to with the author himself, and even though he spent maybe 10 hours in total with Jim Simons, I don't think Mr. Simons wanted to talk much about actually what goes on into Medallion. I think they spend most of the time talking about other things that is relevant for the story. But I think what goes on inside Medallion has come from current and former employees, but not Simons himself, I would say.
Yeah, there's some funny videos out there. I know that there's one that I saw a few years ago where he's on stage being interviewed, and he is sort of talking about how complex and mathematical the strategy is, and the interviewer kind of in an innocent offhand way says, oh, okay, I understand. And he goes, no, you don't understand. You don't understand at all. There's like two people who can understand this, and you do not understand. So it's really humorous. I'm sure I tweeted it over the past few years. But another thing that I read from the articles that popped out, I don't know if you guys saw this. I didn't tweet about it, but it was a little bit of downplaying his, he wasn't the smartest guy at, or isn't the smartest guy at Medallion. And he is the one responsible, I would say, for the success. But to the degree that he knew how to put together smarter people and kick some out and get some others and defend, there's where he goes in and threatens to sue one firm if he doesn't fire those two people, ex-Rentec people that he just hired. And so it was more like he was the coach and the manager and putting this together and making it work. And then I'll get into another great set of tweets where he does a discretionary override to save the firm and basically just, let's take positions off. We're losing too much money. And he gets shouted down by the more mathematical-minded or the people who want to go down with the system. And so I thought that was fascinating. But it's kind of funny that some are saying, or the author gives the impression that his main contribution wasn't he was the smartest math guy, but he was the guy who held them all together.
I mean, obviously you need to be incredibly smart in order to find people who are even smarter than you and then put them together as a team. But it's true, and I think that for certainly in the beginning he wasn't even the majority owner of the firm and so on and so forth. So definitely, and I forget the names of these people who were very foundational and important in the early days of the development of the firm. But it is just a fascinating story. I think everyone should read it. I mean, they certainly, when they started looking at these things, coming from their code breaker math background, they certainly found trend early on. I mean, without a doubt, they were doing breakouts and stuff like that because they found that in the data, that's what was evident to work. But I think one of the things that surprised me is that the way I would describe what they do, and I think it is described like this in the book as well. I mean, what they really became was an early and today a massive machine learning AI shop, really. Letting the machine and not necessarily fully understanding what goes on inside the model. And I think that's the fascination of it. I mean, they admit they don't fully understand all of the things that they are finding in the data. So it's very different from the way we operate, where we fully understand what goes into the model and what the output would be. And that's not the case in their case, which also, I guess, makes it even harder maybe sometimes to stick with the model because you don't really know what goes on inside 100%. So just fascinating. I hope everyone will read this book. It's a great story also about just how quant investing evolved over 3 or 4 decades, essentially, and the dominance that it has today. So, yeah.
I have a story. A good friend of mine, I'm not going to mention his name because I'm not sure if he wants his name on the podcast, but a good friend of mine used to run a part of Goldman Sachs's quant research division for many years and then retired. And he is a math wizard, like really wicked smart in math. And he got intrigued by the track record of Medallion. And, obviously you cannot reproduce the thing using trend following or mean reversion or any of those type of strategies, which we know that just, won't produce the same result. So he had a look at all of the, research papers in which Jim Simons has been involved and all of that, voice recognition type of stuff. And he, it has to do with what is called a money fold, which is a multidimensional topography of data. I'm not going to go into that because I'm lost already. Impossible for me to understand, right? But for his intellectual capacity, he could do something with it. So he's playing with all that stuff. And he's a real good trader, discretionary trader, trading only DAX volatility. And as a side gig, He's building up those manifold type of trading systems, which he runs on paper, I think, for the time being still, but they look absolutely fantastic. And, he says, well, you cannot know why the system takes the position it takes. It will trade certain stocks because they have some manifold relationship, which, the market or the system has found, and it just puts it on. But what I wanted to say is the funny thing is, he said, well, it must have to do with the fact that Jim Simons doesn't wear socks. And this seems to be true. He doesn't wear socks. So during the summer, this friend of mine he's sockless. So like our winters are too harsh here, so he doesn't do it in the winter. But during the summer, no socks. Maybe that helps.
Maybe that helps. No, but it is true. I mean, the book clearly states that when Mercer and Brown came into the firm from IBM, from the speech recognition part of IBM, that had a huge impact. And I think they were split initially between the futures trading part and the equity trading part, but they ended up joining each other on the equity side of things, cracking that finally, which had been really the key for them to grow to this size that they have now. And of course, Mercer and Brown were co-CEOs for a long period of time until recently, when Mercer were kind of forced by Simons to step down, which is another fascinating part. But I think people should read the book and find out why that happened, because that in itself is interesting.
Just another thing I've heard over the years, that he has come out in the past few years and said that specifically the trend following doesn't work. And so, and it's particularly troublesome because he has some trend following in his past. And so I don't know if that's in the book or whatever.
Yeah, but, definitely.
But I think I'll try to put a positive spin on it, and the only positive I could come up with was that, if you have a Sharpe of 3, something with a Sharpe of 0.5, it doesn't work, So in his world, trend following doesn't work, given his 3, 4, 5, whatever the Sharpe is. I mean, it's pretty high. So a 0.4, a 0.5 Sharpe, which is, I guess, sort of typical of trend following, traditional trend following. Maybe that's the best we can hope for, that it won't work for him. But I would not be surprised.
Jim's world.
Yeah, I wouldn't be surprised though that come on, he knows about trend following. He knows what we do, so he may like to take the other side of some of our trades, or figure out ways to get us going long or short, or run us out of trades. And he's probably playing havoc with a few of our trades, minimally, I would say.
You're absolutely right. I like your point about that. If you have other strategies with a much higher Sharpe, then you could certainly argue that trend following doesn't work as well, and you shouldn't include it. But what you find from their trading is, and I think this is probably the reason why they don't view trend following as the right thing for them, is that at least the book portray them as not trading anything outright. Everything is relative to something else. So it's, statistical machine learning, statistical arbitrage, pairs trading, whatever you would call it, at a very high level with a very high dose of leverage. And so, it's definitely not what we do. And we know, they have mastered it for sure. There's no doubt about that. But of course, we know that there are other strategies that employ these type of relative value type strategies that look, for the most part, a lot safer than what we do. And I don't know if there are a lot of other people who can say that they're better. I was looking at, so from the book, there was this article on Bloomberg where they list some of the great managers of all times. Not actually, when you look at them, most of them don't have continuous track records that are 20 years, sure, but not 40 or 45 years, that some of the CTAs have. So, but they have good returns, but they're not spectacular. What's spectacular is really Renaissance. and maybe one other, firm that gets to very high returns. But a lot of them are not vastly different from the longer term trend following strategies, but they're certainly more stable, I'm sure, or have a higher Sharpe without a doubt. So, what else took place in Twitter land, Jerry?
Well, I saw this article about what investors can learn from best poker players, but I kind of ignored it. But then Moritz asked me about this article, and then I read it, and I really liked it, and it was something that has some good thoughts in it, and I tweeted this one. Hedonic framing is thinking about one's money, gains and losses in particular, in ways that maximize pleasure and minimize pain. And I think the point there was you should not do that. And so I added my 2 cents, which were successful trading correlates more to maximum pain. And I think that's kind of what I assumed and learned in 1983, and have certainly, if you trade trend following, small losses, waiting for the big profits, having the big profits turn into small profits, and less than 50% winners. There's a lot of things. It's not about maximizing pleasure. I thought that was a pretty interesting article, and it goes on to say traders and poker players must develop resilience and learn not to be guided by too much by results-based behavior. They must learn that it is possible to do everything right and have a bad outcome. It is possible to do everything wrong and win big.
Yeah, I mean, again, when you look at sort of the comparison between what we do, and we know there's a lot of pain involved in that because it's not perfect. It works over time. But there is a huge difference, right? Because what we do, not only is it explainable, but it's doable. I mean, people can still create trend following models and become very successful. I doubt really that anyone can ever compete with what Renaissance Technologies is doing, or the likes of Renaissance Technologies. I mean, no individual at least can do that, but I truly believe that individuals can have success in trend following. Maybe not the same level of success, but success nevertheless.
What I really like, I mean, this, the thinking of the poker players or those people that play games of, I want to call it games of chance. It's like, probably also backgammon, poker, those type of games, right? Where it's a combination of skill, but also luck. I mean, this is just a, fact. When you play poker, you can be a skillful player, but if you're dealt a bad hand, then the odds are against you, right? So just to frame it such that, this is one round you're playing out of so many that will come in the future. So do not go bust, because if you do that, you cannot play. And don't take it personal. So don't overtrade, don't overbet, right? And don't take the outcome personal, because it's just more important to do the right thing over and over and over again. And then the results should come out the other end.
Yeah, so the luck is basically just a function of a small sample size.
Exactly. And there's always noise around it, even if you're doing the right thing, right? It's a noisy process. It's a noisy outcome, because you will be unlucky every once in a while, or sometimes, more frequently than you wish. And that shows up in bad outcomes or, negative returns. But you must not take those personally. This is not about your system or yourself. This is just nature. This is the game we play.
Yeah, I mean, the other thing, on a slightly related note, I would just say another takeaway from the book is, which is very evident, is, these guys that didn't get to become who they are by not putting in the hard work. I mean, they put in a hell of a lot of work, and a lot of their attention, and I'm sure that's still the case today, they put a lot of attention on getting good data, getting lots of it, but making sure it was good, clean data. Yeah, I mean, we may not have heard much about them in the past, but obviously it's a long-term process for them to have become so successful. It wasn't an overnight sure thing, and rarely things are an overnight success. So good for them.
My last quote from this article I liked, although I wasn't sure exactly what the author meant, but it says, poker players, I added, and traders sometimes miss an opportunity by folding too soon. The only way to avoid those kind of regrets is to play every hand until the end. And so I think that to some degree, maybe for traders, it is a twofold meaning. One is keep applying your system till the very end. Well, till don't follow it down the tubes, but you've got to keep not giving up on your system, but also don't give up on the trade. Maybe that's what he meant for the poker players, is that don't give up on the trade, and for traders, don't take small profits and let the trade go and follow your system. Is like in this gold trade, it's very uncomfortable giving back all the profit from the max, but the trend is probably still intact, and your system probably says to stay long, at least maybe one of your longer term ones. So I think playing it out to the end in the idea that you're going to follow the system that and not getting out too quickly is definitely a way we can make more money in the markets.
Absolutely. But with that, let's jump into our next usual segment, which is a few questions. We have a few questions this week as well. As always, if you want to send a question or two to us that we can dive into on the podcast, just send it to info@toptradersunplugged.com, and we do our best to get it on the show as soon as we can. The first question is from Matt. And let me try and find the email. It's a little long, so make sure that I find just the question here. Okay. In one of the last episodes, I think it was Moritz and Niels who mentioned that they don't really use moving averages as part of their trend following system. I totally get that the price has all the information one might need to make buy and sell decision. My question is this: does your system only just follow the higher highs and the higher lows and vice versa in price action while looking for breakouts and breakdowns in price through this systematic approach? Since moving averages are not used, are there any other indicators or complementary overlays being used alongside the price to aid or assist in getting more robust, higher probability buy and sell signals? Or is the only other addition to the price action the volatility consideration using indicators such as ATR?
Pretty much what he says. I don't want to, speak too negatively about any moving averages. I'm sure that, good trend following trading systems can be designed with them. Think about the 50, 200-day crossover, things like this. I'm definitely not saying that those are bad or don't work. It's just, for me, the way I went about it is pretty much twofold. I'd say, well, all the system works based on price. This is trend following. So why should I be using a derivative of price, which is a moving average, as opposed to the price itself? So it just appeared to me that using the thing itself, the price, which includes all the information, to my belief, the most relevant and best information out there is incorporated in that price. So I just want to use that price directly and not a derivative of it. And then when I look at the way the systems trade, the moving averages versus the breakouts, the breakouts, if you buy the high, you're really buying the high. This is the more painful trade even, right? Because you're really picking that high. And you may get a long position or a long signal by a moving average, which is not really the high price, right? So I also like that feature. It made it even harder to trade, to enter positions. And I also found that the breakouts, they keep me in trades for longer. So I have less of a whipsaw with, my breakout-based system as opposed to like a moving average system, which, crosses in and out all the time or more frequently. And this is about how much I thought I put into that. I started with the breakouts. I looked at some other things, but the breakouts work for me, and I didn't look back.
Yeah, no, so again, on our side, there's definitely we're not saying anything bad about moving averages, and you can certainly incorporate also moving averages as a filter. It doesn't have to be your primary signal generator. I think a lot of it is about personal preference, what you like, price breakouts, volatility breakouts. Time series momentum is another indicator you can use. So there are definitely different ways. But you go on, and I don't need to repeat what Moritz just said, but you also go on and ask whether we use different time frames, daily, weekly, monthly, as part of your system. Of course, Jerry can also jump in on this. But from our point of view, I mean, we use daily data, but clearly we use different time frames because we want to have multiple entry points and multiple exit points. So yeah, we'll use maybe 15, 20, 30 different quote unquote time frames or as a parameter or look back periods for just a single model. That would not be unreasonable to do. So you don't have too much riding on, and of course this is also a function of size, but you don't want to have too much riding on any one entry point as having to work out for you. You can build up your position slowly, you can get out slowly. That's really how we've gone about it. Yeah. Any thoughts on that, Jerry, before we move?
All of those I like and I agree, so I won't repeat, but I would rewind if you're listening and listen to all those again because they're all good. I like them. And but I would also say, kind of in a perverse way, I think breakouts don't move up as quickly. The exit doesn't move up as quickly for instance, in a big uptrend. So if the market closes on its high today, that moving average is going to be impacted. It's going to move up the exit, and you're locking in this profit. Oh, would love to lock in profit. I mean, there's nothing better than locking in profit, and the breakout will disregard that totally. It has no impact at all if a market closes strong and on its highs. It's looking at the lows, and so that's frustrating for us humans who want to lock in those profits. But I think it works better to not lock them in that particular way, and the breakouts are probably more frustrating, more pain, more suffering. So that means they're better.
I love that. That's a very good point.
Yeah, good stuff. Thanks again, Matt, for sending in your question. The next one is from James. James has sent us questions before, so we appreciate that they keep coming, James. This one is probably more for you guys. The article that, so it's a question about sample size and risk management. The article that Jerry posted a couple of weeks back and the recent podcast have touched on a reasonable sample size. I was curious as to how a sample size of 5,000 to 6,000 trades is split up. For instance, if you have 5 look-back periods, that might take you from 20% invested to fully invested. Are you treating that as one trade, initial entry to final exit? Or is it 5 separate trades on the same instrument? The second, which is related to the above, if we ought to diversify through multiple look-back windows, gradually building into a position and reducing it, does this mean each look-back window needs to be treated for risk management purposes independently, i.e. the stop losses and volatility management ? Or, in your experience, is it better to manage the risk on the entire accumulated position at any one time? All right, gentlemen. Some good questions from James there.
Well, I think I understood the question, and that is each system has its own look back, and so you want to count the sample size for each system. So that is the way that I think you should do it. Yeah.
What about you, Moritz, and also maybe the point about risk management, whether you look at the full position or you look at them independently or etc.?
So risk management, look at what exactly does this mean? I definitely look at each position independently, right? So if I'm trading crude oil on one of my breakout windows, of which there are N, right? Yeah. Not just one, but different time frames. Then, if I'm buying crude oil on a high, then for that position, for that window, for that subsystem, if you will, I will have an initial stop and a trailing stop. If subsequent to that, I'm buying more of crude oil because it hits another high on the longer term time frame, then for that position, again, I will have an initial stop loss and a trailing stop, but at different levels than the first time frame. So in that regard, I look at them independently, right?
But I actually think that what you're asking, James, goes a little bit further than that, because I think what you're saying, Moritz, is that yes, you look at them individually and they have individual stops, but you also look at the total exposure to crude that you want to have at any one point in time in designing your system, right? So you can't, you're not going to have 20 entries of 1% in crude. I mean, you have to say, okay, I mean, it's not clear, but I think that that has to be part of the answer, is that yes, you look at it individually, but you also look at the overall exposure. That is defined before anything else. Yeah,
very true. I'm not putting on 1% risk. I mean, absolutely not in every single one of those signals.
Right.
But to your point, if I had 20 time frames, 20 time windows that I traded on crude oil, I would treat them really equally, which means every single one of them gets a 20th of my risk budget for crude, whichever percent of equity that may be, right? Yep. And I'm not favoring the shorter term or longer term time frames in terms of capacity that they would get in the system. They all get the same thing.
Yeah.
And so in that regard, I know that there's a certain amount of risk, a certain amount of maximum risk that I can have in crude oil. Most of the time, I'm not fully on with that risk, right? Because not all of the systems are developed. I mean, in some of the markets, like in the past couple of months, in the bonds, I definitely had that on, and I guess you guys too, right? But in crude oil, it's been quite a while since I've been at full capacity on those markets.
Absolutely.
And then I would look at each one of those 20 individual systems independently. They're getting 1/20th of my risk budget, and I would just pretend that I don't even understand. System 1 doesn't even know about the other 19. They're not related. I set them up to begin with to sort of add diversification on entries and in exits, but they're sort of independent acting. And it may look like, if you're a client and you're seeing the positions, oh, Jerry keeps adding to this winning position, but all I'm really doing is following all 20 different systems that have different look-back periods, different entries and exits. One of the things that kind of intrigued me about the rule was Larry. I tweeted this, and I didn't talk about it in our podcast, but I kind of didn't understand where he was coming from on the rule that is, the tweet about if you want to make money, you take small losses, but if you want to make a lot of money, you add to your winners. And so to some degree, that was beginning to sound a little less systematic than I am, which is, I have this trade, I think I'll add to the winners. It sounded a little less systematic than, I'm going to add to my winners, Larry, but only if when my systems kind of kick in, my predetermined systems. And, if you're using breakouts or almost any sort of strategy system, for instance, 5 through 10, they can all hit on the same day. And the 100-day high is the same as 120, it's the same as 130, blah, blah, blah. So I didn't really understand adding to winners. Is that the same thing? Does Larry think of that as the same thing as Moritz and I trading multiple entries and exits? That kind of looks like we're adding to a winner, but it's each individual system being handled independently from the others and just those trades kicking in. What do you think about that?
I like that. And it's just also like sometimes I hear like, oh, you're pyramiding into your positions. And, this may be true as a matter of fact, when you look at the way the trades develop over time in the bonds, you start and then you get longer and longer and longer because more of those systems kick in. But it's not that I have a pyramiding algorithm defined that, forces the system to buy into winning trades. It's like you say, Jerry, I look at those 20 subsystems or the 20 timeframes as individual managers. They're kind of like individual money managers inside of my system, and I have quite a few of them. And they don't know of each other, really. The result may be that I'm increasing my position and I'm pyramiding in, I'm adding to my winners, but this is not because of a pyramiding algorithm or adding to winners algorithm. It's just, this is how the thing works.
And Niels said something that was critically important a few minutes ago, and that is the plan at the beginning. It was the plan from the beginning. So I've tried to figure out this pyramiding and how it could be wrong or how it could be kind of used pejoratively. And I think it's because it insinuates that now that I have this new open profit, I can afford to do another trade. And we all know that open profit is fleeting. It goes away tomorrow. You can't afford to do it. But if as part of your plan to risk 100 basis points divided by 20 for each of the different systems, it's not dependent upon systems 1 through 10 showing this temporary profit, may or may not be a temporary profit. So now I'll do systems 11 through 20. No. I could afford it from day one with my current equity. And so I think that's critically important, that all of these decisions need to be made from the get-go, from the very beginning of how you're putting your system together, and not on the fly. Oh, now I'll add to this winning position, which I hadn't planned on doing. It wasn't part of my strategy. That's what I don't really think is a good idea. I'm not trying to, I don't even know what Larry meant by that, but I think having a systematic approach that adds to winners because it's looking at different look-back periods and timeframes and other systematic approaches. I think that's great, but I don't think that I can agree that it is the secret to making lots of money. 1 or 2 look-backs, you're probably going to make about the same amount of money. The multiple systematic approach is more so to spread out the pain.
No, I'm glad you expanded on that, Jerry. That's absolutely perfect. Thanks, James. I hope you got lots of things to think about from those answers. Next question is from Brian. Brian, thanks for writing in to us. I have a few questions pertinent to episode 59. So if anyone have missed episode 59, you should go and check that out. It goes, the David Dreuss comment that some of the most robust systems are the most volatile ones because they're not optimized for any particular environment. This comment caused me to pause because it has always been my understanding that the less volatile a system, the more reliable or robust. I was hoping you could expand upon David's comment. And then the second one, the comment that lowering your volatility will lower your returns unless you increase your risk-adjusted returns. So another statement we've made. Once again, this was cause for pause, since it has always been my understanding that the lower one's volatility, the better one's compound returns. I'm not so sure I quite understand that one. Anyways, maybe you did. So let's dive into maybe the first point about volatility and robustness. One of our favorite topics. We talk about this on a reasonably regular basis. Moritz, do you want to jump into this, or?
Yeah, I'll do it. But let me start with the second part of the question before I forget it. It was the lower the volatility, the higher the return, or the higher the compounded return.
Yeah,
it's something along those lines, right?
Yeah, the lowering your volatility will lower your returns unless you increase the risk. And then it goes on. My understanding that the lower one's volatility, the better one's compound returns.
So that one, I, with all due respect, I do not understand, because volatility is not what makes you money. Return is what makes you money and what shows up in your account, right? So you may think about a system that has 20% vol and 0% return. You can have a system that has 10% vol and 0% return, still 0% return, or 5% vol and 0% return, still 0% return, right? So that just are two completely different things. Less volatility is more convenient to more people because it's like the smoother journey. But it doesn't mean that if you have a smooth journey and low volatility, that your return is going to be high. It's just two different things. And then the robustness part, well, and we've said this before many times, you can use Excel or Python or any tool you want and feed it with data and spend a week or a weekend massaging that data, finding a system or using some search algorithm to find a system that produces a fantastically smooth equity curve that starts at the lower bottom left and ends at the upper corner on the right. And this will be characterized by low volatility and high return, right? Because this is how you've just curve fit it. This is how you've just data mined that thing. And it's probably going to have a lot of parameters. And it appears to be robust because the return series looks so nice. But in reality, what you've created is something that is extremely fragile and very, very opposite of robust, because what you've just created is it's very unlikely to repeat itself in any shape or form in the future. So there is going to be, with a high degree of certainty, system failure as soon as you start trading this. So it is important that you focus on simplicity and not adding too many parameters and rules in order to have the statistical significance of that system protected, and in order to create a large sample size upon which you can analyze the returns and come to conclusions. And what you will see then at the end of that is that your returns are going to be much more volatile because you don't have that many parameters, and you need to allow for the system kind of like to breathe up and down in order to get to the return. And if this isn't clear, I mean, and it's still probably my favorite example, is imagine selling on a weekly or monthly basis the 95% or 90% out of the money put on the S&P, right? Ever since the global financial crisis, this system, with the exception of last year in February and maybe the fourth quarter of last year, but there have been a few dips, right? But for the past 10 years, this strategy has produced enormous results, really nice returns, right? And in a very smooth way, because we've just had a bull run in equities for like all of that decade. And the corrections haven't been that painful. There hasn't been a global financial crisis or a Black Monday in the past, 10 years. It just didn't exist. So you create that, you trade that. It is smooth, but it is extremely risky. And it may show you a kind of like carrot today that there is a nice return to be had, kind of like blinds you because you're taking on so much risk. And if you trade it, I'm pretty sure that strategy long enough and you're picking up those dimes in front of a bulldozer, then you have a very high chance of your final return being minus 100%, not zero, minus 100. Which means you go out of business. So just when you think about these things in the markets, I believe it's important to, take it for what it is and not over-engineer those things to only have a nice, back test, or to put the risk into some dark corner of the left tail of the distribution where you don't see it until it comes to bite you.
So lots of things to take away from that. Let me just add a few things from my side. I'd love to hear your comments as well, Jerry. In terms of the first comment about the more robust systems tend to be more volatile, I think from my point of view, and again, we talked about this, so this is just saying what Moritz just did, but in a slightly different way. And that is, to me at least, a lot of these very smooth return streams, to me, they seem to be warehousing the risk, and it may not be expressed until, one day, and then suddenly everything goes wrong, and you find out that the risk was there. It just hadn't been expressed. While
Exactly.
the more volatile strategies like trend following, we recognize and we realize the risk every single day because we mark to market our positions. And we don't believe that you can take inherently volatile markets, put them through some kind of formula, and suddenly you're only left with the good stuff, the return, with no risk. So I think about it, and in that context, and then maybe the comments we've made previously make more sense to you, Brian. In terms of the lowering returns and so on and so forth, I think maybe there's a missing point in the question or the way you think about it, and maybe we didn't express it well enough previously. But what I mean by if you lower your volatility, you lower return. Essentially, you're lowering your volatility because you're taking less risk, right? So I'm not talking about necessarily that you find some magical formula whereby you can in fact lower your volatility but remain, as profitable as you were before. I think what we've talked about in the past is that we've seen our industry, because we know institutional investors, they like low volatile strategies. So I think part of the reason why I say trend following as a whole, the industry of trend following, have seen their returns drop. There are a number of reasons for it, but I think one of them is by design. Like David Harding from Winton, who have openly come out and say, I have lowered my volatility. But he's also lowered his return at the same time. So I think that's what maybe that's where this statement comes from, that by lowering returns, you're also lowering by lowering your volatility, you're lowering your returns, unless, and that's the point, unless you're able to increase your risk-adjusted returns. You find that magic addition to your system that actually allows you to improve your risk-adjusted returns, meaning you still deliver the same returns, but you just do it with less volatility and lower drawdowns.
And the worst case scenario is to have a system that has too many variables and not robust, and not a good sample size, and then leveraged it up. Whoa, big trouble. So I think I thought that, ironically, I looked up the Dreuss quote. I have it, and it's just what you've been saying. And it's kind of funny that unless you're Jim Simons, it might be fair to say, you need to not only embrace the volatility, but you're going to be in big trouble if your winning percentage is more than 50%, and you don't have these big drawdowns. So you want to have a lot of volatility, a lot of drawdowns, all your profits coming from just a very few trades, and a low winning percentage. Now you're in safety, unless you're Simons, which probably it has the opposite of all of those. But I think it's important to understand as well that this approach of not allowing volatility and having rules that eliminate too much of the volatility is it's a backtest problem, because more than likely in the future you're not going to make money. And so you won't even have you probably will have more volatility and less profits than the back test looks like. That's the whole problem. But in the short run, you can definitely get lucky with an overfitted system and have profits and not have these drawdowns. And I think prior to getting that evidence, I think it would be reasonable to see that, if you have a system that has a couple of rules and it's not overfitted and it's definitely robust, you still have the opportunity to have this oppressive money management overlay that comes in and starts doing all kinds of trades, cutting back, reducing risk, volatility targeting, whatever, that's not really part of the back test. And so I think that's likely as well, that you can be very happy with your system because it is robust. It doesn't have a lot of variables, but in the implementation, if the system trades are overwhelmed by more of a money management or risk management or all of these terms that people want to use to make their discretion somewhat immunized, you're going to run into the same problem. It's the exact same thing. You just can't slap money management on it or risk control on it and say, oh, I trade a robust system, when the majority or a huge part of the trades are sort of non-system trades.
The other thing I just want to add to this conversation, and that is, we talk about Renaissance being perfect, but they weren't perfect all the time. They had their 30-40% drawdowns. We just don't know about them because it's not really part of the official track record, or maybe it is, and we just don't see them. But they talk about these in the book and how some of the some of the positions were stopped out because they hit their 40% drawdown level. I don't remember the year this occurred, but it's described there. So it's also been a journey of trial and terror in their case. And by the way, this is super important. Just because Renaissance and the likes of Renaissance have been super successful in the last 10, 15, 20 years, etc., if what they're doing is based a lot on machine learning, if the environment changes dramatically and suddenly, that machine learning can blow up. There's nothing to say that they will always deliver these type of returns just because they've done it in the past. So, and they, as I said, they trade with, healthy leverage. So, and there are a lot of people, I'm sure, not a lot, but there are a few of the really, really big mega funds that are doing probably something very similar. So can you imagine if something happens that their systems are not able to handle, and it happens at the same time for all of these mega funds with all the, things can change. And so I think what we're trying to say is that by not designing the perfect system that delivers positive monthly returns all the time, we feel at least that our approach is better equipped to deal with whatever comes in the future, because we're not relying on the future to be equal to the past.
Yeah, every single bet that we place may be like this trial and error that you've just mentioned, right? We try and then it becomes an in quote error because it hits our stop loss, but it prevents us from being trial and terror. It's just that one. You have to make sure you get that out on Twitter. That's a really good one. We're normally not in the trial and terror space.
Good stuff. Thanks, Brian, for your questions. And what we love about all of these questions is that usually sparks a little bit of a discussion on our side. So we do appreciate you sending them in. Final question today is from Gaitano, who writes, this is a question I think most likely about how to implement some of these things. Gaitano goes, do you use ETFs such as SPY, GLD, TLT in place of or in addition to futures? Normally when a futures contract notionally value is bigger than my account liquidity, I will not trade it. Also, it's easier to scale a trade with ETFs according to ATR. Yet I'm left with a long only approach and I pay extra commissions. I think just for me to jump in on this one, first of all, I don't think any of us trade ETFs, but it doesn't mean you can't use an ETF. And I think there are more and more now, there are definitely a movement in some markets. It could even be the I think it was Charles Schwab who came out this week at their conference to say that they're now going to allow for fractional share trading, in addition to making it commission free. So keep that in mind. So things are getting basically free, and you can trade smaller fractions of a stock because some of the stocks have become so expensive. With futures, you can't trade fractional futures, so that is more difficult. But the important thing is to make sure you base your signals on the instruments you trade. I think so. We always say this. You trade what you test, and you test what you trade. I think that's important. Taking signals from a futures market and implementing it in other ways other than the instrument itself might be a bit more tricky and maybe not so precise. But you have to do what you have to do, Gaitano, and I think that's the key thing. And you seem to be taking just that approach. Anything you want to add, Moritz?
I think it's like you say, Niels, it's perfectly doable. There are no fractional futures, and for some people who don't have a very large account, trading the ETFs is perfectly fine. The way that space has developed over the past couple of years, especially with equity index ETFs and also the bond ETFs, there's like pretty much everything all available under the sun these days for very attractive prices, certainly in the US, right? So trading the SPY ETF or any of those other S&P ETFs, yes, why not? I guess the limitations are still a bit more on the commodities. Like if you wanted to find an ETF that really is good at tracking coffee or cocoa or, you know, some of the other like smaller commodity markets, maybe difficult to find that one. But sure, I mean, for equities and bonds, I say that's a go.
Good stuff. Good stuff. Those were the questions for this week. As I said, if you want to have us comment on some of your curiosity, then just send it to info@toptradersunplugged.com. Let me quickly run through this week's performance, where we stand. The Beta 50 index is up 20 basis points for November, up 6.33 for the year. SocGen CTA index flat completely as of Thursday, up 601 for the year. SocGen trend index down a fraction, 35 basis points for the month of November, up 8.54 for the year. SocGen short-term traders index up 0.5%, which makes it up 2.5% for the year. And we have the Bridge Alternative Index, which is down 1% so far in November, but still up 7.39% for the year. Before I ask you if you have anything else you want to add to this, we've been talking a lot about Jim Simons this week, and for good reason. But I don't think we should necessarily forget that another prominent hedge fund manager, namely Ray Dalio, published another thought-provoking piece this week. And I picked up one of the quotes, actually from George, his weekly email. He had also found this quote in the post, and Ray Dalio goes, "Because investors have so much money to invest, and because of past success stories of stocks of revolutionary technology companies doing so well, more companies than any time since the dot-com bubble don't have to make profits or even have clear paths to make profits to sell their stock, because they can instead sell their dreams to those investors who are flush with money and borrowing power." So I thought that was a nice little reminder that there might be some exuberance going on in the new all-time highs we see at the moment. But as Moritz said earlier, we just don't know when that exuberance will come to an end.
That's right.
Anything else, guys, that we should bring up before we bring this conversation to a close?
Well, probably for the first time, I didn't get through all my tweets, so remind me. I have some really good ones still going with Simons, and then.
Do you want to do one now?
We can wait till next week. Just don't let me forget, because I want to. And Wayne has a great one as well. So we got some material.
Perfect. Well, it's nice to be long on material.
Exactly.
We should. Okay. All right.
Looking forward to the one from Wayne.
Yes.
Yeah. Okay. Cool. Okay. Well, I mean, on that note, we're going to wrap up this week's conversation. We hope you enjoyed it. And of course, if you felt you got some value from today's conversations, please share it with your own tribe or follow us. We are grateful for a rating or review on iTunes. Anything that can help other investors discover our little podcast, we would appreciate that. From Jerry, Moritz, and me, thanks so much for listening. And we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next